US inflation is softer than expected as the Fed nears its next rates decision, Australian consumer confidence falls, and China's GDP beats forecasts. That's coming up in our 5 Things in 5 Minutes on Wednesday, July the 16th. And then, in our deep dive interview, ANZ Head of FX Research, Mahjabeen Zaman, looks at how the Aussie dollar is trading in line with more Asian currencies than just China's.
If you are looking to offload Asian currencies and there's no liquidity, a proxy would be the most liquid in that time zone would likely be Aussie. And so that's why we see Aussie really bearing the brunt of negative news in Asia in New York and London time zones.
But first, in 5 and 5 with ANZ, US core CPI inflation rose 0.2% in June, up slightly from May, but less than expected. Headline inflation rose 0.3%. ANZ economist Bansi Madhavani says overall price pressure remains benign, but it would still be wise for the FOMC to wait before cutting rates.
In general, the broad price pressures were somewhat modest, and there was no sharp uptick in prices on the back of tariffs. Now, in itself, such data would have added to confidence that the FOMC will resume cutting rates very soon. But the increased uncertainty about tariff rates and the extension of deadline for trade talks to 1st of August tells us that the FOMC will need few more months of data to be able to cut the policy rate. Our baseline forecast continues to remain that the FOMC will resume cutting rates at its September meeting.
As of 4 a.m. Sydney Melbourne time, the S&P 500 was down 0.1%. The US 10-year Treasury yield up 6 basis points to 4.491%. The US 30-year yield rose over 5% to 5.01%, up 4 basis points. Gold down 0.8% at $3,333 an ounce, while West Texas Intermediate oil futures were down 0.9% at $66.38 a barrel. The US dollar index was up 0.6%, meaning the Aussie dollar was down 0.6% at 65.14 US cents, and the Kiwi also down 0.5% at 59.45 US cents. Number 2. Exports supported China's economy to grow 5.2% in the second quarter from a year ago. That was down from 5.4% in the first quarter, but was ahead of expectations. ANZ senior China strategist Zhao Pengsheng says trade won't support activity so much in the second half of the year as domestic deflation becomes more of a risk.
Nominal growth rate was only 3.9% below 4%. I think the biggest gap between the nominal and the real term is deflation. China PPI is deeply negative. CPI was also mainly negative in the first half of the year. Recently, I think the government have started to take measures to fight against this orderly price competition between factories. But the result or the effect, I think it will take time to watch.
Number 3. In Australia, ANZ's Roy Morgan Consumer Confidence Survey showed a fall of 2.1 points last week to 86.5. Here's ANZ economist Sophia Ngala.
What we think is largely behind that fall was due to that surprise decision by the RBA to keep the cash rate on hold at 3.85%. There was also a broad-based decline across the sub-indices where we did see our confidence in economic conditions weaken, suggesting that the RBA hold likely also had an impact there.
Number 4. Sophia says expected rate cuts later in the year should provide further support to confidence.
With that surprise RBA decision that went against that widely anticipated rate cut that people were expecting, we did now see that previous upward trend in consumer confidence has stalled for now, but we still expect some upward movement in the consumer confidence measure through the rest of this year, just supported by that robust yearly growth in household disposable incomes and those further rate cuts that we expect of 25 basis points in August and November to flow through to households and support confidence there.
Number 5. India's trade deficit narrowed slightly in June from May as import values fell 3.7%. That was faster than exports, which fell 0.1%. ANZ economist Dheeraj Nim says high-tech exports perform well, although this was offset by weakness in mid to low-tech goods.
For now, I think the trade balance could remain in the vicinity of this $20 billion every month. At the same time, it's worth highlighting that services surplus was higher in June than in May at about $17.3 billion. And this was entirely on the back of super performance of services exports versus a slight contraction in services imports. Overall, of course, the large services trade surplus or the growing services trade surplus will remain an important mitigating factor for the overall goods trade deficit.
Nim there. Now, in our deep dive interview, ANZ Head of FX Research, Mahjabeen Zaman, looks at how the Australian dollar has been acting as a proxy for Asian currencies during recent turbulence, particularly for traders in London and New York.
So look, I think the Aussie dollar trades in line with the broad array of Asian FX, not just the CNH, which is understandable given our close trading relationship with China. But broadly, the Aussie dollar is often seen as a more liquid alternative to Asian currencies, especially during the New York-London hours. And as such, during that time zone, if you are looking to offload Asian currencies and there's no liquidity, a proxy would be the most liquid in that time zone would likely be Aussie. And so that's why we see Aussie really bearing the brunt of negative news in Asia in New York and London time zones.
And how close is that correlation? Has it become closer in recent years?
Yes, it has become closer. I mean, first we can talk about the Aussie and CNH or CNY correlation, of course. As a key trading partner, the economic outlook for China is significant. That also sort of exaggerates the moves. And then when we look outside of the CNH, we look at other cyclical currencies within the Asian basket. That's Korean dollar, Taiwanese dollar, or the Thai baht. They are again very much risk sensitive, so they tend to swing much more. And as a result, if you're looking at the Aussie as a proxy to let's say Korean won or Taiwan dollar, the impact would be much sharper in again London and New York hours. So yes, I agree with that.
And you've got some interesting charts in a note you've done talking about how the Australian dollar is the most sensitive. Why do you think it's more sensitive than, for example, the New Zealand dollar or Canadian dollar, particularly the Canadian dollar? They also have strong trading relationships with China.
Yeah, look, I think when we look at the Aussie and the Kiwi dollar, between the Aussie and Kiwi, again, Aussie dollar is much more liquid in all time zones. That's one thing. And also when we look at the trading relationship with China, we do know that China, of course, they have had challenges on the property sector, but their demand for iron ore has reasonably kept up. However, I think the bigger challenge in China is building up your domestic consumption. And if we look at what do they buy from New Zealand the most, it's around those dairy products. And if domestic consumption in China is low, they might be looking for cheaper substitutes locally. So that correlation might be a little bit weaker then.
And in terms of the correlation between the Australian dollar and the CNH, how closely related to an overall global risk sentiment is it?
Yeah, look, I think that's quite interesting because when we look at the more less volatile Asian currencies, that is the CNH and the Singapore dollar, which are less sensitive to risk sentiment relative to the Aussie. And we have seen some examples around the Aussie CNH cross, during risk-off market environments, or if you have a carry trade unwind, then of course the performance of Aussie and CNH has at times diverged, but more so we see it to be kind of, again, more correlated. But there are these offshoots where you see this breakdown as well.
Mahjabeen Zaman there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, July the 16th. Catch you tomorrow with a look ahead to Australia's June jobs market numbers. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.